Hi everybody, my name is Griffin Bridgers. Welcome back to the basics of generation skipping transfer tax. This is part 10 where we're going to talk about the estate tax inclusion period, or the ETIP. As always, before we get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So to recap, in part 9 we discussed GST trusts in the context of the automatic or manual allocation of your GST exemption. And the key takeaway there is that you must have a GST trust in order to take advantage of automatic allocation of GST exemption. Otherwise, if you fail the GST trust rules, you have to manually allocate your GST exemption if it makes sense to do so. However, what we briefly introduced in that discussion and line of thinking is the concept that both automatic and manual allocation of GST exemption may not be available during a certain period of time that might apply to an indirect skip trust. And that period of time is known as the estate tax inclusion period, or the ETIP. So as you can imagine, this video is all about the ETIP, the acronym for the estate tax inclusion period, which can be kind of confusing, but is actually simple once we take a step back and get a sense of what is going on. Now, there's one overarching principle I've been talking about and alluding to so far, and we're going to get into that a little bit more later too when we look at practical applications in the shift of transferors. But before diving into the ETIP, it helps to kind of cover this transferor shift and the big picture of that. So way back in parts 1 and 2, we introduced the primary term we have to know, which is transferor. Formally, that's the person who is making a transfer that benefits a skip person, which is subject to gift or estate tax reporting at the time that that transfer is completed. And thus, because of that, it's subject to the allocation of GST exemption or the payment of GST tax at the same time that there is gift or estate tax reporting. However, property in a trust may not be static. It may later be subject to further gift or estate tax reporting. For example, if it's subject to a gift if a beneficiary gives up their interest, or if maybe a beneficiary or even the grantor dies, that those assets are included in that person's gross estate. So around this concept of transferor shifts or later gift or estate tax reporting, we need to keep in mind that any allocation of GST exemption at the time of the transfer could be wasted if there's this risk down the road that there could be further estate or gift tax reporting. Why? Because every time there's estate or gift tax reporting, any prior exemption that's allocated is wiped clean, and there's a new allocation at that time, either of the original transferor's GST exemption or a new beneficiary's GST exemption. So every time that happens, there's some wasting potentially of GST exemption, which leads to this ETIP rule we're going to talk about, which kind of saves us a little bit from this potential wasting of GST exemption issue. So what is the estate tax inclusion period? Well, the ETIP is better thought of as a period during which the transferred assets could be included in the gross estate of either the transferor or the transferor's spouse. So how does that happen? Well, we'll talk about that in a minute, but the significance is that no GST exemption can be allocated during this ETIP. But at the end of the ETIP, GST exemption will automatically be allocated based on the value of the property subject to the ETIP at the time that that ETIP ends. We'll look at a practical example of that, but as you can imagine, if property grows over time, what that means is that the value at the beginning of the ETIP is much lower than it will be at the end of the ETIP. So it's not always a good idea to allow for that automatic allocation of GST exemption at the end of the ETIP. So because of that, it's usually a good idea to elect out of automatic allocation, either at the time of the transfer, the beginning of the ETIP period, or at the close of the ETIP period. Depends on how proactive you are, and sometimes people miss this, and this can be a big error whenever you have a transfer subject to an ETIP. which we'll get into a little more. So the testing period, this ETIP, starts at the time of the original transfer. In other words, at the time that there's a transfer subject to gift or estate tax reporting. And it considers whether the assets would be included in the gross estate of either the transferor or the transferor's spouse if either of them were to die immediately after the transfer. So this kind of shows that this period starts at the time of transfer and runs until there's no more risk of inclusion in the gross estate of the transferor or the transferor's spouse. So to get to that point, to determine when that period closes, it's largely dependent on the type of transfer and the types of rights or interests that are creating this gross estate inclusion. So, for example, that could include a term interest or a lifetime interest, depending on certain types of trusts. It could also practically get into the weeds on the terms and benefits and control of the trust, and maybe with respect to the transferor, consider whether the transferor has retained any interest or control that might create a completed gift, but nonetheless result in gross estate inclusion under Code Sections 2035 or 2038, which raises an important splitting of hair here, that the only time you can have an ETIP with respect to the transferor is if the transferor makes a lifetime gift to an indirect skip trust, typically. However, with the transferor's spouse, this could be any transfer either during the transferor's life or at the transferor's death, but the transferor's spouse could have an interest, maybe such as a general power of appointment, that would cause the assets that are subject to that general power of appointment to be included in the spouse's gross estate. So there's a lot of different micro rights that we're not going to dive into in greater detail, which is why I emphasized that it helps in this class to have some knowledge of basic gift and estate tax principles before you really tackle the GST tax itself. So if these are kind of foreign concepts to you, I'd encourage you to kind of go back and explore these code sections 2035 through 2038 and 2041 as well, which deals with general powers of appointment. But what about other beneficiaries? It may be the case that maybe we make this transfer and, for example, we just looked at general powers of appointment with respect to the spouse. What if you give another beneficiary who's not the transferor or transferor's spouse a general power of appointment, maybe other than a crummy right, such that a significant portion of the trust assets might be included in that beneficiary's gross estate if they were to die immediately after the transfer? Well, the big question here is, does that create an ETIP? The answer is no. The ETIP only tests with respect to the transferor and the transferor's spouse. However, last time in Part 9, we looked at these tests to have a GST trust. If you recall, one of the tests that you can fail is the question of whether any portion of the trust is includable in a non-spousal beneficiary's gross estate. And if that's the case, you won't have an ETIP, but you will fail the GST trust test, and you don't get automatic allocation. And even then, manual allocation in that type of circumstance may not make sense because of that transferor shifting type of analysis, especially if the beneficiary in question is not a skip person. It may be better to wait and have that beneficiary allocate their own GST exemption at the time that they die because of the gross estate inclusion through that general power of appointment. So the big question is, where do you really see this apply practically? So the common examples of trusts that commonly create an ETIP might include things like GRATs, QTIPs, charitable remainder trusts, both annuity and unit trusts, and possibly reversionary CLATs as well. Now, CLATs have their own separate rules we'll look at later, but another common example that seems intuitive, like it would create this issue but has some special rules, is a QTIP trust. Now, I know QTIP and ETIP sound very similar to each other, and there's not necessarily a reason behind that, but it does help to think of them in the same vein around this exception. But if you have a QTIP trust, then whatever portion of that trust for which you make the QTIP election will be included in the beneficiary spouse's gross estate at their death, or could be subject to gift tax reporting if the beneficiary spouse gives up their interest in that trust during life. So because of that, it seems like there would be an ETIP with respect to a QTIP trust? And the answer is typically yes, there is, but there's a way you can get around this rule in the form of an election we're going to look at in a little greater detail later in terms of its mechanics. But that election is known as the reverse QTIP election. And what the reverse QTIP election does is it allows you to shortcut and bypass this ETIP rule to say that even though the assets will be subject to gift tax reporting later on with respect to the beneficiary spouse, then as long as that reverse QTIP election is made, then the definition of transferor never shifts from the grantor spouse to the beneficiary spouse at some point in the future. So no matter what, if you make the reverse QTIP election, the original grantor spouse will always be treated as the transferor with respect to the QTIP elected portion of the trust, and also the QTIP elected or QTIP non-elected portion for that matter, which is its own separate discussion. But essentially what this means is that the grantor spouse can allocate their own GST exemption to that trust, and that prior allocation of exemption isn't going to be wiped out when the beneficiary spouse is subject to estate tax reporting or gift tax reporting in the future on that QTIP trust. So like I said, we'll dive into that in greater detail, but the consequence is that if that reverse QTIP election is not made, then the beneficiary spouse is going to have to allocate their own GST tax exemption to that trust. Whereas if the reverse QTIP election is made, the transferor, the grantor spouse, locks in their own GST exemption allocation at the time that the trust is funded. So kind of a unique thing here, and just as a hint, this is a good way to get around some of the issues that arise with the fact that portability does not preserve a deceased spouse's unused GST tax exemption. So, for the time being, practical application of ETIPs, I always like to look at the lowest hanging fruit. And the two most classical examples I can give you of an ETIP would be with a grantor retained annuity trust, or GRAT, and also a qualified personal residence trust, or QTIP, because these are trusts that usually have a limited term where they're funded, but the transferor, the grantor, retains for themselves an interest, either an annuity interest under a GRAT or the right to use a residence under a QTIP, but at the end of the term, whatever's left in that trust goes on to remainder beneficiaries other than the grantor. So it's that remainder interest gift that could potentially benefit skip persons in the future and seems to create that GST potential that would drive allocation of GST exemption. However, these types of transfers are subject to an ETIP period. So that means that when they're funded, no GST exemption can be allocated to these types of trusts. Now, remember earlier we talked about how there's automatic allocation at the end of the ETIP period? Well, that can happen here, and that could have a bad outcome. It's usually good to elect out. Why? Well, we'll look at a practical example here. Let's assume that the grantor funds a zeroed out 10-year GRAT and puts $2 million into it up front. So there's no gift tax cost to doing it. Now, intuitively, since you have zero gift tax costs, but still some gift tax reporting, it seems to make sense that you could also allocate technically zero GST exemption, but also get a GST exempt trust. But you can't. Why? Because of the ETIP period, which says that there's no allocation of GST exemption until the earlier of the end of that 10-year GRAT term or when the grantor dies. So what that means is that until that ETIP closes, there's no allocation of GST exemption. So let's assume that the grantor outlives the 10-year GRAT term. At the end of the GRAT term, the assets have grown to $5 million. So significant growth within this GRAT. But what that means is that if nothing else happens, then at the end of the GRAT term, the grantor would have to allocate $5 million of their GST exemption to that GRAT, which, as you recall, was funded upfront with zero gift tax exemption. So you're funding this with zero gift tax exemption, but all of a sudden having to use $5 million of your own GST tax exemption at some point in the future. That's a bad outcome and a very wide disparity. So because of this, typically you would elect out of automatic allocation of GST exemption. And you have to do that either upfront when the GRAT is funded or at the end of that 10-year GRAT term in this example. Otherwise, you run this risk that at the end of the ETIP, GST exemption is being allocated based on the value of the trust at the end of that ETIP, which is pretty much always universally going to grow depending on the term of the trust. So long story short, because of this ETIP rule, most retained interest trusts like GRATs and QPIRTs typically will not be exempt from the GST tax. So they may go outright to non-skip persons, or they may pour into a remainder interest trust, but that remainder interest trust will typically always be a non-exempt trust. So practically, if you're ever looking at a family's estate planning picture and you see included a trust that's specifically called a GST non-exempt trust, then usually that's going to represent a trust that's been funded with the remainder of some retained interest trust like a GRAT or a QPIRT. So that's the ETIP in a nutshell. There's more nuance to it than that, but we're not going to muddy the waters and dive into that anymore. Instead, we're just going to tee up for some future discussions. Coming down the pike is going to be a long series on gift tax reporting, the GST exemption allocations on Form 709, and the manual or automatic allocation strategy. And peppered into that would be special considerations for certain types of trusts, like we just talked about a GRAT or a QPIRT. Also, an ILET may have special considerations, but the ILET will be tabled until later on because we're going to have to discuss a couple things, one being the reverse QTIP election, the other being how the GST tax has its own annual exclusion, but how the rules for that work a little bit differently than the gift tax rules, which create different treatments of crummy rights for gift tax purposes versus GST tax purposes. Also look into some valuation principles around the timing that we've seen within the GST tax itself, and also grandfather trusts and gallo trusts, which depending on when they're funded, as long as there's been no constructive addition, may be non-exempt just by virtue of their time of existence and funding amount. So that aside, so far here's our glossary of terms, and we've added one more to the end of the list today, which I haven't bolded as usual, but that is the estate tax inclusion period. So I thank you for joining me for this part 10 of the basics of GST tax. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for joining me for this video. I look forward to seeing you in my future content.